Something extraordinary just happened, and most investors won't understand it until it's too late. While headlines were still forming, gold in Asia was trading nearly $300 above Western prices. Silver was pushing historic premiums. Oil risk surged. And crypto, the so-called digital safe haven, dropped. This isn't just volatility. This is capital repositioning in real time during a confirmed military escalation. The question is not whether markets reacted. The question is whether they are signaling something much bigger beneath the surface. The most important financial lesson in this entire development is not that military action began. It is that markets were already moving before the confirmation ever reached the public. That should immediately capture your attention. Because in finance, timing tells you everything about who knew what and when capital decided to move. In the days leading up to the official announcement of U.S. military operations in Iran, gold, silver, and oil were already rising together. That kind of synchronized movement across safe haven metals and energy is not random volatility. It reflects capital repositioning for geopolitical risk. When multiple asset classes that typically respond to instability begin advancing in lockstep, it signals that institutional money is adjusting exposure ahead of an anticipated event. Markets do not wait for press conferences. They price probabilities. What makes this particularly significant is that mainstream financial commentary had not fully framed the situation as imminent war. Yet price action suggested elevated conviction. That divergence between media narrative and market structure is critical. Markets operate on forward expectations. When informed participants perceive rising odds of escalation, they hedge through assets that historically protect against currency debasement, supply disruption, and macro instability. Gold attracts defensive capital. Silver benefits both from safe haven flows and industrial hedging. Oil reflects potential supply chain risk, especially given Iran's strategic position in global energy transit routes. This sequencing matters because most retail investors react to headlines, while professional capital allocators respond to risk models and intelligence signals. By the time a geopolitical event becomes public knowledge, asset prices often reflect a meaningful portion of that risk. That is why understanding intermarket relationships is more valuable than reacting emotionally to breaking news. The key takeaway here is structural. Price action is not noise. When commodities tied to inflation protection and energy security move in coordinated fashion before a confirmed military escalation, that is a form of financial signaling. It suggests that probability-weighted outcomes were already being recalculated behind the scenes. The headline may confirm the event, but the capital movement often confirms the expectation long before the announcement ever reaches the screen. At first glance, many investors may be tempted to treat this development as just another geopolitical flare-up, another headline spike that fades within days. That assumption could be costly. The structural distinction between this operation and the June 2025 strike is not cosmetic. It materially changes the risk framework markets must apply. In June 2025, Israel acted independently, targeting nuclear infrastructure in a limited, time-bound operation. The market reaction followed a familiar pattern: an initial equity sell-off, a bid into safe haven assets, and then stabilization once it became clear that the Strait of Hormuz remained undisrupted and the conflict was contained. Duration risk was minimal. Without sustained disruption to oil flows or direct U.S. combat involvement, institutional desks treated it as a temporary geopolitical premium rather than a structural shift. This time, the variables are different, and in markets, variables determine valuation. The current operation involves explicit U.S.-Israel joint military engagement, direct targeting of Iranian leadership and military assets, and open rhetoric suggesting regime change. That language alone shifts probability models. When a conflict expands beyond infrastructure, strikes into leadership and systemic targets, escalation pathways multiply. Markets do not price just the event. They price the range of potential outcomes that follow. Duration is the key financial variable. A short, contained strike creates volatility, but rarely alters macro trajectories. A multi-week campaign with retaliatory risk affecting regional shipping lanes, energy infrastructure, and allied military bases changes capital allocation decisions globally. Oil markets respond not only to physical disruption but to the risk of disruption. Insurance premiums rise, shipping costs increase, and futures curves adjust. That filters into inflation expectations, bond yields, and currency flows. The explicit acknowledgement of endurance and potential casualties further differentiates this episode. When policymakers frame an operation as sustained rather than tactical, markets reassess how long elevated uncertainty may persist. That influences volatility pricing, safe haven demand, and equity risk premiums simultaneously. Institutional investors are not evaluating whether a strike occurred. They are evaluating whether this event introduces structural instability into energy markets and global trade routes. If the probability of prolonged engagement increases, then comparisons to June 2025 become less relevant. Markets rely on precedent, but when the underlying structure changes, precedent loses predictive power. While most Western investors were asleep and futures markets were closed, price discovery did not stop. That is where the signal becomes impossible to ignore. Gold did not wait for New York to open. It repriced in real time in markets that trade continuously, and the magnitude of that repricing demands attention. The PAXG gold-backed token spiked toward $5,600 per ounce overnight, materially above the previous Western close near $5,078. At the same time, spot pricing in China implied roughly $5,560 per ounce when converted from yuan. That represents an extraordinary premium, more than $280 above Western paper benchmarks. In normal market conditions, arbitrage mechanisms compress those gaps quickly. When the premium expands instead of compressing, it suggests friction in physical supply or urgent demand overwhelming liquidity channels. This is not just volatility, it is a stress indicator. Gold's role as a reserve asset becomes most visible during geopolitical escalation. Physical buyers in Asia, where gold ownership culture is deeply embedded, tend to respond rapidly when uncertainty intensifies. If buyers are willing to transact at materially higher prices while Western futures are closed, it signals that the perceived fair value of physical metal is adjusting upward independent of derivative pricing. The distinction between physical and paper markets is critical here. Futures contracts represent claims on gold, physical markets represent possession. During periods of stability, those two pricing systems track closely. During stress events, divergence can emerge if immediate access to bullion is prioritized over financial exposure. A $280 premium is not routine noise, it reflects urgency. Currency considerations also matter. If regional participants anticipate prolonged instability, currency volatility, or oil-driven inflation risk, gold becomes a monetary hedge rather than simply a commodity trade. The repricing in Asia suggests capital was seeking protection before Western markets had the opportunity to respond. The key financial question is whether that premium narrows once futures reopen or whether it persists. If Western pricing gaps higher to close the spread, it validates the overnight move as true price discovery. If it attempts to suppress the gap through aggressive futures selling, the tension between physical demand and derivative supply becomes the focal point. Premium expansion during closed Western hours is often the earliest signal that the global gold market is entering a higher risk regime. When a major physical gold dealer halts trading in the middle of a volatility surge, that is not a routine operational decision, it is a market signal. Dealers exist to facilitate liquidity. Their business model depends on continuously quoting two-sided prices, managing spreads, and hedging exposure through futures or spot markets. If they step back entirely, it suggests that price discovery has become unstable enough to threaten risk management controls. In this case, a large Southeast Asian gold dealer paused transactions, citing excessive volatility. That detail deserves careful attention. Physical dealers typically widen spreads during fast markets. They do not close unless pricing becomes too unpredictable to hedge safely. This implies that the pace of repricing in underlying markets outstripped the dealer's ability to manage inventory risk. When volatility disconnects from hedge capacity, liquidity temporarily disappears. This highlights a critical distinction between quoted price and executable price. Futures markets may continue trading electronically, but physical distribution networks depend on real-world inventory, transportation, credit lines, and counterparty confidence. If a dealer cannot reliably source or hedge metal at a stable differential, quoting firm prices becomes hazardous. That moment reveals stress beneath the surface. Liquidity withdrawal in physical markets can amplify volatility further. When participants fear they may not be able to obtain product, demand accelerates. That acceleration widens premiums and intensifies divergence between physical and paper benchmarks. The pause itself can reinforce the perception that supply conditions are tightening. From a financial systems perspective, this is about more than one regional dealer. It reflects how rapidly geopolitical shocks can ripple through commodity supply chains. Gold markets operate on a combination of trust, logistics, and hedging efficiency. Disruption in any of those components alters market depth. If multiple dealers were to adopt similar measures, it would signal broader strain in distribution channels. Professional investors monitor these developments closely because physical market stress can force futures markets to reprice. Derivatives rely on the assumption that physical delivery mechanisms remain functional. When a key participant steps aside due to volatility, it introduces uncertainty about that assumption. In periods of escalation, the stability of liquidity providers becomes just as important as the direction of price. If you think silver is simply riding gold's momentum, you are missing the deeper structure of this market. Silver is not just behaving as a secondary safe haven asset. It entered this geopolitical event already under measurable structural strain. That context changes everything about how this move should be interpreted. Before any military escalation was confirmed, the silver market had been operating in persistent supply deficit for multiple consecutive years. Industrial demand tied to electronics, solar infrastructure, electric vehicles, and energy storage has remained robust, while above-ground inventories have steadily declined. COMEX registered inventories had already fallen significantly, lease rates were climbing, and physical premiums in Shanghai were elevated before the first strike occurred. Those are not reactionary war metrics. Those are pre-existing tightness indicators. Now, layer geopolitical risk on top of that foundation. Silver occupies a dual identity in financial markets. It functions both as a monetary metal and as a critical industrial input. When uncertainty rises, investors seek hard assets. When energy security becomes a concern, industrial policy accelerates toward electrification and solar deployment, both silver-intensive sectors. That creates a rare alignment of safe haven flows and industrial consumption pressure at the same time. The Shanghai premium exceeding Western pricing by double-digit dollars signals that physical demand was already pulling metal eastward. A geopolitical catalyst in that environment does not create the thesis. It accelerates it. In markets with surplus supply, safe haven spikes often fade as inventory absorbs demand. In a structurally tight market, additional demand compounds scarcity. This distinction matters for price behavior. Gold typically absorbs monetary demand more smoothly because its above-ground stock is vast relative to annual mine supply. Silver's available float is smaller relative to industrial usage. That makes it more sensitive to marginal shifts in buying pressure. When volatility enters an already constrained system, price swings can be amplified. Investors analyzing silver through the lens of historical geopolitical pullbacks may underestimate the current backdrop. The question is not whether silver rallied alongside gold. The question is whether the market entered this event with enough available supply to absorb incremental safe haven flows without forcing repricing. Structural deficits reduce that buffer. When monetary demand intersects with industrial tightness, the response can be more forceful than traditional war-driven rallies alone would suggest. Here is where the situation becomes technically serious. The widening gap between physical pricing in Eastern markets and paper pricing in Western futures exchanges is not just an interesting statistic. It is a stress test of the entire price discovery mechanism. When that spread expands meaningfully, it forces a critical question. Which market is leading reality? Under normal conditions, arbitrage keeps global gold and silver prices tightly aligned. If gold trades higher in Shanghai than in New York, traders exploit the difference, moving supply or adjusting futures exposure until the gap narrows. That mechanism depends on liquidity, transport efficiency, stable hedging conditions, and confidence that futures contracts reflect deliverable supply. When a premium widens instead of compressing, it suggests friction in that chain. The $280 premium in gold and the double-digit premium in silver represent more than volatility. They represent urgency in physical acquisition. Buyers in Eastern markets were willing to pay materially more than Western paper benchmarks. That behavior implies that immediate possession carried greater perceived value than financial exposure. In times of geopolitical escalation, possession risk and counterparty risk enter the equation more aggressively. The divergence between physical and paper pricing also highlights structural leverage in derivatives markets. Futures contracts allow large volumes of exposure relative to underlying deliverable inventory. That system functions efficiently during stable conditions. However, if physical demand accelerates while available registered inventories remain constrained, the confidence gap can widen. Markets may temporarily rely on institutional selling to cap futures prices, but sustained physical demand eventually forces reconciliation. Professional investors monitor this divergence closely because it can signal regime change. If Western futures open and immediately gap higher to align with Asian physical pricing, the system is absorbing the shock. If futures attempt to compress the premium through coordinated selling while physical markets continue bidding aggressively, the tension increases. That tension is not ideological, it is mathematical. Paper pricing ultimately depends on deliverable supply. The broader implication is that geopolitical events can expose underlying structural imbalances that were already present. The divergence between physical and derivative markets does not create instability on its own, but it reveals where fragility may exist. When investors begin prioritizing direct ownership over contractual exposure, pricing power gradually shifts toward the physical side of the equation. If there is one variable that can transform a geopolitical shock into a sustained macroeconomic event, it is oil. Everything else, metals, equities, currencies, responds to perception. Oil responds to logistics, and logistics determine inflation. Iran's geographic position places it at the center of one of the most critical energy choke points in the world, the Strait of Hormuz. Roughly 1/5 of global oil consumption passes through that narrow corridor every single day. That statistic alone should recalibrate how investors think about escalation risk. When military operations involve a nation that influences such a vital artery, energy markets do not wait for confirmed disruption. They begin pricing probability. Analysts have projected that even a limited disruption could add $4 to $8 per barrel almost immediately. That may sound incremental, but oil operates on a compounding mechanism. A modest structural increase flows directly into transportation costs, manufacturing inputs, shipping insurance premiums, and ultimately consumer price indices. If oil sustains a move above key psychological thresholds, inflation expectations begin to adjust. Bond markets react, currency markets recalibrate, central bank policy assumptions shift. The distinction between a headline-driven spike and a structural repricing is duration. If naval retaliation, shipping harassment, or airspace closures persist, risk premiums embed into futures curves. Energy traders begin factoring in longer-term uncertainty, not just temporary volatility. That changes hedging behavior across industries, from airlines to petrochemicals to global freight operators. Oil also interacts with silver and gold in complex ways. Elevated energy costs increase production expenses for mining operations, potentially tightening supply further. At the same time, higher oil prices reinforce safe haven flows into precious metals as investors hedge inflation and currency risk. The interconnection magnifies impact across asset classes. Markets have historically demonstrated resilience to isolated geopolitical flare-ups. But when the world's most critical oil transit route becomes part of the equation, the consequences extend beyond regional conflict. Energy is embedded in every sector of the global economy. If the Strait of Hormuz shifts from theoretical risk to sustained operational threat, the financial system does not simply experience volatility. It absorbs an inflationary impulse that can alter macro trajectories for quarters, not days. For years, Bitcoin has been labeled digital gold. That narrative sounds compelling during bull markets, when liquidity is abundant and risk appetite is strong. But moments of real geopolitical stress are where narratives are tested, not marketing slogans. When missiles are launched and global uncertainty spikes, capital reveals what it truly trusts. In the immediate aftermath of the strikes, Bitcoin declined sharply, dropping toward $63,000, and more than $100 million in leveraged long positions were liquidated within minutes. That is not the behavior of a traditional safe haven asset. It is the behavior of a liquidity-sensitive, risk-correlated instrument. When volatility surges, leveraged exposure unwinds quickly in crypto markets because much of the positioning is speculative and margin-driven. At the same time, physical gold in Asia was trading at significant premiums and approaching record highs. That divergence matters. Safe haven assets are defined not by their branding, but by their performance under stress. Gold has thousands of years of monetary history, deep central bank ownership, and established settlement infrastructure. In crisis environments, institutional capital prioritizes assets with established legal frameworks, clearing systems, and physical backing. Crypto markets, while increasingly institutionalized, still rely heavily on exchange-based liquidity and derivative leverage. When uncertainty rises, risk managers reduce exposure to assets perceived as volatile or speculative. That often includes cryptocurrencies. The rapid liquidation of leveraged positions underscores how quickly digital assets can transition from hedge narrative to liquidity event. This does not invalidate the long-term thesis for blockchain technology or digital assets. It simply clarifies market hierarchy during acute geopolitical shocks. In genuine war-driven uncertainty, investors seek assets that minimize counterparty risk and maximize historical stability. Physical gold's simultaneous surge while Bitcoin declined highlights that distinction clearly. Professional investors analyze these divergences not emotionally, but structurally. If an asset is to function as a crisis hedge, it must demonstrate resilience during actual crisis conditions. In this episode, capital flowed toward traditional hard assets and away from leveraged digital exposure. That behavior provides insight into how institutional risk models categorize crypto versus precious metals when geopolitical escalation becomes tangible rather than theoretical. Every experienced trader knows the pattern. A geopolitical shock hits, futures gap sharply at the open. Financial television turns urgent, safe haven assets spike. And then, within hours or days, markets begin to normalize. It is called the gap and fill response. The real question now is whether this situation follows that familiar script or breaks it. Institutional desks operate on precedent. In June 2025, when tensions escalated after Israeli strikes on Iranian nuclear facilities, equities sold off at the open but recovered once it became clear that energy flows through the Strait of Hormuz remained uninterrupted. Gold initially surged, then retraced as worst-case scenarios failed to materialize. That episode reinforced a behavioral template: fade the spike once containment becomes visible. That template will likely guide positioning as futures reopen. If gold and silver gap significantly higher in response to Asian premiums, coordinated selling pressure could emerge to compress spreads. Large institutions often test the conviction of early buyers. If the conflict appears contained and oil stabilizes, risk assets may recover quickly, reinforcing the normalization narrative. But here is where caution is necessary. Markets normalize when uncertainty collapses. They struggle when uncertainty compounds. The effectiveness of the gap and fill strategy depends entirely on duration and escalation signals. If retaliatory actions expand, if shipping lanes face credible disruption, or if official rhetoric signals prolonged engagement, the probability of rapid normalization declines. Another key factor is structural positioning entering the event. If speculative longs were excessive, liquidation pressure can accelerate retracement. If positioning was moderate and physical demand strong, pullbacks may be shallow and short-lived. Institutional attempts to cap rallies through futures markets can succeed temporarily, but they rely on underlying supply availability and stabilizing macro signals. Investors should focus less on the initial spike and more on what happens in the first two trading sessions. Does the gap hold through Monday? Does oil maintain its premium? Do physical market spreads narrow or widen? These details determine whether markets are absorbing the shock or merely pausing before repricing again. The gap and normalize playbook has worked repeatedly in recent years because geopolitical flare-ups were brief. The durability of that strategy now depends on whether this conflict remains a headline event or evolves into a sustained structural risk. What makes this moment potentially different is not just the outbreak of conflict, but the convergence of multiple reinforcing forces activating simultaneously. Markets can absorb a single catalyst. They struggle when catalysts overlap. Right now, 4 accelerators appear to be operating at the same time, and that overlap is what professionals are watching closely. First, war-driven safe haven demand is immediate and emotional, but also systematic. When geopolitical instability escalates, portfolio managers rebalance toward assets perceived as stores of value. Gold benefits directly from this shift, and silver participates both as a monetary metal and as a secondary hedge. That flow alone can move prices sharply in the short term. Second, dollar weaponization and reserve diversification remain an undercurrent in global capital flows. Over recent years, several central banks have increased gold purchases as part of broader reserve strategy adjustments. In periods of geopolitical strain involving major powers, the incentive to diversify reserves can intensify. Central bank demand is not speculative, it is structural and often price insensitive. Third, energy disruption risk feeds directly into industrial dynamics. If oil prices rise or supply chains face uncertainty, governments and corporations accelerate investments in alternative energy infrastructure. Solar panels, electrification systems, and energy storage technologies all require significant silver input. That links geopolitical instability in oil-producing regions to potential long-term industrial demand for silver. Fourth, the metals markets were already structurally tight before escalation began. Persistent supply deficits, declining exchange inventories, and rising lease rates indicate constrained availability. When new demand layers onto an already tight system, price elasticity decreases. Even moderate incremental buying can produce outsized price responses because the buffer is thin. Individually, each of these forces is manageable. Together, they form a compounding framework. Safe haven flows reinforce central bank accumulation. Oil risk reinforces inflation hedging. Industrial demand intersects with supply constraints. The interaction between these variables increases the probability that price movements are not purely reactionary spikes but reflections of deeper structural stress. Markets do not move in straight lines, and volatility will persist. But when multiple demand channels activate against a backdrop of constrained supply, the resilience of prior normalization patterns becomes less certain. Investors evaluating this environment must consider not only the headline event, but the layered forces already in motion beneath it. The next 48 hours are not about emotion, they are about structure. Watch the futures gap, watch the physical premiums, watch oil, because when markets lead headlines, the smart money is already positioned. Verify everything, think independently, and make decisions based on data, not noise.